How about Leggett and Platt?
What is Leggett and Platt? Sounds like a law firm.
Yeah, Leggett and Platt is I can never find the
Based in Missouri.
Yeah, Missouri-based
designs and produces engineered components and products found in home, offices, retail stores, automobiles, and aircraft. 4 segments: residential, furniture, include components, machinery, steel infrastructure, furniture. Okay.
What is the market cap for Leggett and Platt?
5.5 billion, 24 PE, that's an X.
Oh boy.
9% profit margin, that's an X.
Oh,
Again,
0 for 2.
0 for 2, but we're not crazy terrible. 4% dividend yield. By the way, the last company could easily afford their dividend yield, in case you forgot.
Oh yeah, their dividend was 4.5, Paul. So
yeah, it was $27 million a year. They could easily afford it. So 4% here on 5.5 billion is 220 million, roughly.
Okay, what is the pillar number 3 is the revenue growth for Leggett and Platt
For the last 5 years.
last 5 years.
Okay. 3.9, 4.75, check mark there. But if you look back here, 10 years ago it was 3.35. So there's not much growth happening per year. Nice, steady, boring company.
You love these.
I prefer them.
How about profit growth? Pillar number 4, profit growth, baby.
325, 333.8, check mark there. And shares outstanding, 141 to 135 million, check mark there.
Nice.
We have revenue growth, profit growth, and shares decreasing. So we have 3 checks, and we start off with 2 X's. So that's pretty good.
Leggett and Platt. We're looking at the current assets over current liabilities, Paul.
1.518 versus 947. So check mark there. Definite good check mark there.
Pillar number 7 is free cash flow growth, Paul. We want this growing, baby.
Okay, so cash from operations less capital expenditures. So we have 255 million versus 525 million. Check mark there. And then we also have 428, 273, 283, sorry, and 280.
The free cash flow over the past 5 years average has been about 350 million.
350 million. Okay. If you want to multiply, so this one is not growing a ton. This looks like a big jump here, but if you look at it, it goes from 255 to 428 down to 283, 280, 525. So I think 15 times is reasonable.
Why did you choose that number one more
because
time,
I look
Paul?
at it, the historical average of PE is 15, and over long periods of time, PE and free cash flow should be about the same. Earnings and free cash flow should be about the same. So if we're looking for an overall average, they have reasonable revenue growth, not a lot. They have reasonable free cash flow, even though this is a big jump from here. There's a lot of up and downs. So I still like the average. I'm looking at 15. Now let's see how the last. So it's 15 times 350, 4.5, 52, 5.25 billion, and it's currently at 5.5 billion.
Yes.
That's a check mark there. But one thing I want to keep in mind: they pay $220 a year in dividends.
4% dividend, Paul.
Yeah, 4.5. So they're eating up a big chunk of their average free cash flow, but not of their most recent. So it's something to consider here, guys. It's not terrible. This is actually in the realm of possibility. So I'm actually like not upset about this.
Okay.
Question I have is manufacturing. What's their advantage in manufacturing? Do they manufacture here? Do they manufacture overseas? What's their deal? Yeah, this isn't bad. It's just, I mean, that gross margin's not very good, 22%. But you can always, the guy who taught me, his goal is to find a reason to say no. I'm looking for reasons to say yes, because if I see a no that's so obvious to me, I'm immediately going, I'm out.